ask our other presenters up today and we'll proceed with the panel discussion. And I encourage everyone, and obviously it's panel discussion, it's not just a discussion amongst the panel, it's a discussion from you folks as well. So if any questions is in your mind, feel free to throw it out to our panelists, and I'm sure they'll be able to answer, or at least endeavour to answer them for you. So I guess as the chair, I'll start off and probably direct the initial question to Warren. So I suppose you did address this anyway to a degree, but what's your read on the current instability in the Middle East? How will it impact the world and Australian economies?
Look, if it stays where it is, like an Israeli operation to flush out and eradicate Hamas, then I think we can see from the way global markets are going that it's not going to have major implications. It's all about the escalation. And at this stage, that seems to be contained. So, look, it's really just a matter of watching. But if we see this played out how the Israelis want it, and that is that they flush Gaza, they go and try and set up some sort of a non-Hamas government. And, that's obviously a very costly exercise for Israel, but for the rest of us, it'll...
And presumably the allies as well.
Yeah, of course, there's be a lot of support coming from America and other places, but I don't see that as being a game changer. But if you started to see much more active engagement between Iranian and US forces and more US troops on the ground, and anything, I think that it remains the case that the thing you're watching is the oil price. That's the main channel. And of course, it's exactly what the world doesn't need. We're trying to slow down these economies to get rid of inflation, and a significant spike in oil is stagflationary. It's the opposite. It hurts growth, sure, but it adds to inflation. It'd just be sort of a rerun of the 1970s, sort of in terms of the risks and the parameters around it. So look, we're not out of the woods, but so far so good in both terms of the oil price and also this thing not getting out of control or getting away from just being a Hamas-Israel thing.
I guess, like in terms of, you probably also answered this in terms of your thing. I get the impression you're not totally in favour of how the Reserve Bank's gone about controlling inflation.
Yeah, look, I've been forecasting for 25 years, and it's all good in hindsight. But I've been very clear from the start that you underestimate. Where you're going to get yourself in trouble is underestimating the resilience of the economy, the persistence of inflation, and that's what they've done. I think they should have started this. I mean, you look at it, they've done 425 basis points, but let's go back to the start of this week when we're making the case for a rate hike. They've done 400 basis points, and 300 of those were last year. They've only done 100 basis points this year. So that impulse, that monetary tightening is going to soon fade from the economy. And what you're left with after that, what the RBA is, it's like the one thing they don't want to talk about is the real interest rate. In this country, we have not got our cash rate above core inflation. Every other central bank was tightening until that happened. The Fed did not pause. And they paused in June when they got their cash rate above 5 and inflation was at 5. That's a zero real interest rate. That was always got to be the first sort of policy target. And the RBA has ignored that. And I think, and the reason I worry about it is not because I've got a mortgage and I care about the economy, and it's not going to help judo sticking rates up. But I don't want to see the rate go up to a point that it breaks the economy, as I said. And I think they've just been too softly on this, and they should have gone harder. The bottom line is that we have very few examples in our history or any other modern economy's history where you get rid of inflation without a real interest rate significantly north of 2%. And if they allow the inflation to build in some momentum into the system, then I think that's where they're heading themselves. They had an opportunity to stomp on it early and they didn't take it. And what even these other central banks that did, it's not clear that it's going to work for them either. So, yeah, I disagree with it, but I said I've been saying it from the start. I hope I'm wrong. Other policy tools, other things they can do apart from raise rates. Well, I just don't know. I mean, we are getting some signs that businesses are starting to get affected, that they're not able to pass on the cost pressures, and that'll hurt profitability, and they'll start to pull back. And if that happens, the economy may slow and we may get away with, this may be the peak. I don't know. I mean, I'm less willing to be bold about my forecast than I was at the start of this year. At the start of this year, I just, looking at the economy. But what scares me, what scares the life out of me as an economist, is if they have to take that cash rate up towards 5.5, 6, I can tell you what will happen, and that will cause a lot of distress and hurt this economy big time. The problem they've had is they've had certain players, a lot of them political, telling them the economy is about to fall over. The bank economists haven't helped. They've been constantly saying, oh, they're only going to go to 2.5, they're only going to go to 3, they're only going to... There's been this completely misdirected narrative. It's the worst I've ever seen in my career. No one wants to see rates go up, but where the narrative was wrong was that it's ultimately the level of interest rates that matters. It's calibrating the interest rate to the economic fundamentals. What we've seen in the last little while has been, as in just prior to the pandemic and through the pandemic, is just a one-off, completely out of whack. So we're rapidly normalizing. We need to do more. Can I see it? Yes, I can, unfortunately. I can see them dragged kicking and screaming, and then I can see them having what I used to call an undie-changing moment, when they suddenly realize, oh, shit, and they have to hike every month for 3 months or 50 points. That's why I said they should have gone 50 in February. I think they should have gone 50 now. You got to remember, if they've overcooked it, they can cut 100 points any day of the week they want. They can reverse it within a second. Maybe not a second, but a day. It's all about politics. It's all about presentation. They've shot their credibility to pieces. Thank God she raised this week, because that would have been the end of it. But so yeah, look, it hasn't been great, and I just hope we don't pay the price. I hope we start to see some real concerted signs of a slowdown, and we are seeing them. It's got to be more, and it's got to last longer.
Oh, Andrew. Sorry, mate.
Okay. Warren, given the RBA's reluctance to step up, is there any levers that the world's greatest treasurer, Mr. Chalmers, could pull?
Yeah, there's probably about somewhere between 2,000 and 20,000 levers. I mean, monetary policy is an interest rate. For people complaining about rates going up, before they say we've got to stop raising rates, well, let's get rates back to their normal level, which is a 2% real cash rate, which right now is a 7% cash rate, which of course none of us want. So let's inflation get down. Let's say it's 4 or 5, normal. Okay, but then you're not going to get rate cuts. Then let's take that world, and then let's see what the government's going to do. Well, is it going to be agile enough? Is it going to have the political capacity? The reality is the government's got huge amounts of things it can do. Finally, they've cottoned on at the behest of the IMF that it's actually the state governments that are blowing the whole thing up with all their spending as well as infrastructure. The idea of cutting back on infrastructure projects is not only ridiculous, you can't do that quickly enough to meaningfully. I mean, unless you're going to literally blow a whistle and down tools on every building site across the nation. And of course, we need this infrastructure. I mean, most of the complaints in my career is we haven't built enough. So look, the bottom line is they missed an opportunity in the budget to cut back more. I actually said, and I said it to the Treasurer, you should have done twice as much cost of living relief for low income earners and cut back more. You should have sort of basically done a cost cutting exercise of 10% in the public service. I mean, all of us in the private sector have to go through it every whatever amount of years. But yeah, there's heaps of levers they can pull. So yeah, they can raise taxes. They can, and the thing is, you can't raise taxes on the rich because it's not going to change anything. You got to raise taxes on everyone, and they're not going to do that. And not only, I don't advise them to do that. They should be cutting back on spending. So look, there's heaps they can do. They don't have the political appetite. The federal government does deserve some credit. They're not making things a lot worse. But they're not doing a lot. But it's the state governments that are a real problem. But all of those ships have sailed. Our problem is now, and the problem with fiscal policy, unless they announce a tax hike or some sort of spending cut immediately, it's very slow to operate.
Do you have a question at some stage, Peter?
How real is a threat of stagflation in the future?
Yeah, I mean, I'm not that worried about it. I think the circumstances that led to the 1970s are different now. One of the biggest and most profound changes in the global economy, Western global economies or advanced economies, and ours is the rolling over of the baby boomers, which creates labour scarcity. And so we're now coming to learn that this labour scarcity is not just a COVID phenomenon. And that's why I say immigration is such an important asset we have, because we know how to do it. People want to come here, et cetera, et cetera. So, yeah, I mean, I think labour scarcity is the big issue that we've got to deal with. Did that answer your question?
Just a question. I've got a couple of questions actually. First one's certainly for Mark, but follow-up question maybe for the panel wider as well. So, with some challenging times ahead for the agribusiness sector, Mark, what do you see as some of the typical characteristics of the players of the operations which are going to outperform the average? And then follow-up question might be linked to that. As we see some distress coming into the sector and some businesses and large farming operations coming up for sale, where do you see the money coming from or the investment coming from? Who are the players that might come in and make some acquisitions there?
Okay, yeah. Well, to do the last one first, we're still seeing a lot of interest from mainly in the Canadian super funds. So there's still big super funds that are looking at farms, and see that in horticulture as well. But that's broadacre. And I think that's generally because they take a longer term view. So they look at the fundamentals generally and say, okay, yeah, this is still a good play. Whereas we tend to, Australians too, and the financial sector within Australia just tends to look at short term. So that leads into answering your first question is those players that do have the long-term view. Yeah, I mentioned the macadamia growers before. There were some my colleagues who bought large farm and expanded their farms when it was $6 a kilo. They did their sums on $3 a kilo. I think this is nice and safe, and it's now like $2. But they're still positive because the underlying fundamentals for the macadamias is still strong. So it's not labour intensive, and it's a highly mechanised industry, and the nut market is strong, you know, generally globally as well as locally. So I think it's those players. The key, like a farm, is the same as any business. You've got to know your costs. A lot of farmers don't really know what their costs are. So those people who understand their costs and are prepared to invest in the farms too. But the problem I mentioned about the farm incomes coming down, or they're being really high, and you may think, oh, that's great, they've stocked up. But we've got to remember that they only just came out of a drought in 2019. After the drought, then had COVID, floods, and fires. So ability to restore their financial stocks too is under stress. But yes, those players who know the markets, who know their costs and invest in their farms are going to the ones that's got.
Right, yeah, we might get Neil and involved. Yeah. So I guess I'll bunch a couple of questions up together there, if you like, mate.
Sure.
So I guess are there enough financing options available in the agricultural space? And rightly or wrongly, the rural space has a reputation of being conservative. What do you think are the particular challenges of introducing a new finance product to the sector?
A couple of questions, and they do tie well together. First off, I'd say no, there's not enough funding options in the agribusiness sector. If you stretch it out to the broader economy, and especially in the metro areas and in commercial finance, one of the stark trends in the last 20 years has been a proliferation in the number of lenders supporting businesses. it's no longer just the big banks or the small banks. There's, the full tier of funders from finance companies that specialize in certain industries to different parts of the value chain and trading cycle all the way up to private equity and private lenders. Whereas the agribusiness, sector hasn't had that level of proliferation of lenders. It's very much the major banks, the regional banks, and then really clear air until you end up in private equity and private lending. So that's where, Judo has entered that space in the market, really overlapping with the major banks, getting up towards where that private lender is stepping in to support those businesses. So, and, we've seen it across the whole economy. And you guys will see with your clients, there are plenty of businesses out there that should be banked by the banks and regional banks, but aren't. And that's what we're looking to come in and support. That kind of rolls into that second question. And also, I'll put my hand up. I was the biggest cynic about lending to agribusinesses as Judo Bank. I thought, you're targeting businesses that have had generational relationships with banks. 200-year-old brands that have had positions in market, and Judo's coming in as a 6-year-old business or 7-year-old business, as last year trying to establish it. And I've got to say, I've ate a lot of humble pie on that and been very wrong. As soon as we planted the flag, it's been like drinking out of a fire hose. And I think as to why that has come about is really our proposition is very much like what banking was like 20, 30 years ago. Relationship based bankers who are capable of understanding this time and getting to know their clients and are able to make common sense decision on the back of that in a market where the backdrop is cost out, industrialization of decision making and what have not, where people aren't necessarily able to be supported the way that they would have expected or like to in the past. So while there are challenges in that, at the moment the biggest challenge is actually getting bodies on board to make the demand in the market. We've grown from 3 to 12 in very short order, and there's far more demand out there. So keen to keep it going along. The market's been very supportive. Our referral partners have been very supportive, and it's been a great opportunity. So looking forward to see continued growth in the market. I know there's a few headwinds as both Mark and Warren has spoken to, but agribusiness is not a single year affair. It's very much about being there through the cycle, and the businesses and operators are there through the cycle and tend to support them through that. Thanks.
Anyone out got any questions burning a hole in their pocket?
Whatever.
Listen,
sorry, I'll jump in there before we close.
Okay.
What's the house view on credit spreads looking forward? And then second, what is impact on agriculture if rates go to, let's say, 7%, 2% above the cash rate?
Good question. I'll talk from a lender's perspective with not a whole lot of coverage across agribusiness spreads, but I think so what Warren mentioned around water interest rates as a whole, and this has impacted credit spreads too. There's been factors in market that have resulted in a real compression. Like if you look at the cost of debt at privates through, or at the riskiest end of the spectrum, once you're starting to talk significant dollars, still single digits, which in historical terms that is really cheap cost of funding. And when I was in business, 15, 20 years ago, 10% for debt wasn't an unreasonable number. So, and the fact that you get that on for really non-compliant stuff, like there's been a very strong compression there. And part of that was to do with the fact that base rates have come down as much. The money printers were running, there's capital everywhere available, and people are seeking a return. I think you're going to start seeing that decompress. You're seeing the major banks, like their profit returns are probably not where people have expected them to be, in terms of where they're operating. And so with these, I guess the features like, quantitative easing, particularly low interest rates dissipating, you will see spreads bump out. That's my view anyway. I'm not sure if that's a house view.
Just on I don't think we're going to get to a 7% cash rate anytime soon. The economy will buckle before we get to that point. But if you go further down the track, 5, 7, 10 years, if my view that that's sort of where we're headed, or normalization or higher for longer looks like that, and then we make those adjustments, the question becomes, you know, what happens to credit spreads in that process? And I think you will see credit spreads be part of the process of normalization, and they might even be now. But effectively, it's going to be demand and supply for funds, whatever the RBA wants. And part of the higher for longer story from a macro fundamental point of view is that it's interest rate is essentially about balancing saving and investment within the economy. Now, it's obviously more complicated than that, but there's big features. And over the last 20 years, with the baby boomers coming to retirement, we've had a lot of savings, and at least in the 10 years prior to the pandemic, investment was pretty soggy. But we've seen the world change. We're going to start to see over the next decade savings drawn on, and we're going to see a lot of investment in tech and energy and climate, and a whole bunch of other things are going to get businesses investing, labor scarcity, and that balance will shift. So that's part of the higher for longer story, and that will mean that there'll be outward pressure on credit spreads too. Is it's essentially debt capital will get scarcer and scarcer every 5 years looking forward for the next 20 odd years would be my prognosis, and that'll put outward pressure on credit spreads. That's a medium to long term story. That's certainly not relevant for the next couple of years.
Any other questions, folks? We might leave the panel there because I'd imagine that we're heading towards the point where everyone wants to get back in front of their computer and start their work day. So I guess on behalf of Paul Chadwick, I would like to thank our presenters today, and if we could, Warren, Anil and Mark, and if we could show our appreciation.